All right, guys, how is it going today? Happy Saturday. Today, I am going to go over calendar spreads. Okay, it's a good spread trading strategy that I use quite frequently. And I'm going to go over in a lot of detail here today, as much as I can, why I use it, why I use it so often, and just all the details around the trade in general. But before I get started, I just want to say, if you're watching this video, just go ahead and hit that like button, okay? Just hit the damn button. I spent a lot of time putting this stuff together for y'all, and I know that you're going to find it valuable. So do me a favor, hit that damn button, and let's move on, okay? All right, so let's get started. So calendar spreads, all right, aka horizontal spreads, okay? The reason it's called a horizontal spread is because it is the same strike price at two different expiration periods, okay? So, basically what you're doing is you are selling a near-term option strike price, and then you're buying a farther-term option strike price for the same strike price with either both calls or puts, right? So you'd either be selling, say, next week's call and then buying a call, a 1 week after that, or you'd be selling a put for next week and then buying another put at the same strike price a week after that. Okay, so for example, right, a call calendar spread on stock XYZ, right, is trading at 180. Okay, so you would sell the 185 strike call for 2 weeks to expiration, and then you'd be buying the 185 strike call for 4 weeks to expiration. Okay, now with all of these calendar spreads, you are paying a net debit for these spreads, okay? So there is a defined loss on these. There's no unlimited loss, like with selling, like ratio spreads or, short puts, short calls, stuff like that, right? So, what you pay is what you get, right? That's the most that you can absolutely possibly lose on the trade, okay? And sometimes even less, right? And I'll go over that later. So basically, what you're doing when you enter a calendar spread is you're essentially betting that the stock price will stay near your strike prices as time passes, right? You're just saying that, it's going to stay range bound, or it's going to stay, right around, like for this one up here, it's going to stay right around 185, right? That's kind of what you're betting on this, right? And honestly, like stocks for the most part, more times than not, they chop around, right? They kind of whipsaw, especially here recently, right? Now, these work because the near-term option loses value quicker than the far-term option, right? So, that if you put a calendar spread on it, 5 points out of the money or right at the money, like, well, why am I making money on this trade when, the stock's not moving anymore, right? Well, that's just because if you understand the options Greeks, theta decays a lot faster on options that are expiring in the near term, right? And it becomes exponential the closer you get to expiration, right? So if the stock is right at your strike price, theta, you are going to be long theta, and you are going to make more money from the premium you're selling than the premium that you're long, right? Okay, so like I said, these are long theta strategies, right? So what does that mean? That means we're making money with the passage of time. We're benefiting from time decay as opposed to just buying a naked call or buying a naked put, right? Okay, so, we have that luxury with calendar spreads, okay? Now, they're also long vega, right? And I have in parentheses here, but are they really, right? Because, when you read about these things, they all say, yes, they're long vega, and yes, they are net long vega, right? So the front option is short vega, right? So anytime you're selling an option, you are short vega, right? Which means if volatility increases, you're going to lose money. If volatility decreases, you're going to make money. The back option is long vega, okay? So that means that you will benefit from an increase in volatility, okay? And if volatility goes down, you're going to lose money, right? So, and there's things, and I encourage you all, if you're not familiar with the options Greek or implied volatility, I really implore you to go back and just, peruse Google a little bit and learn about delta, gamma, vega, theta, implied volatility, and read about something called volatility skew, right? Because IV, it's very dynamic, right? It changes all the time. And sometimes IV will change differently on different strike prices, different expiration periods, right? It's pretty complicated. But, once you have a good understanding of it, it kind of becomes second nature to you. So, I encourage you all, if you're trading options, to fully understand exactly the ins and outs of what you're trading, right? Okay, so with these calendar spreads, they can be either delta neutral or directional, right? Depending on your strike price selection and your assumption of, what might happen, right? So, what do I mean by that, right? So, the example above, where I was talking about stock XYZ at 180 and you're doing a call counter spread at 185, that's kind of delta neutral, right? Like if you're putting the strike prices very close to the stock's current trading price, that's more delta neutral, right? Because you are neither long nor short delta at that point. You want the stock to say exactly where it is, right? If you're directional, right, then you're going to put it more out of the money, okay? So, in that example above, a stock XYZ is at 180 and, I think it's going to go up to 200. So what you would do is you would just, you would enter into a 200 strike calendar spread, a 200 strike call calendar spread. Okay. So that was a more directional trade. It's going to have more positive delta, right? The farther out of the money it is, the more delta it's going to have, the more you're going to benefit from the move in that direction, okay? So, like I said above, the max loss is the debit paid, okay? So, if you enter in a call calendar spread for $500 debit, that's the most you can absolutely lose, even if you let the damn thing go completely to expiration on both ends, okay? Max gain. So what is the max gain, right? The max gain is, it's not easy to quantify like it is for like a credit spread or a debit spread, right? A credit spread, the max gain is the credit that you received when you enter the trade. The debit spread, it's kind of the opposite, right? If you're in a 10 wide $2 debit spread, the max gain is 800, right? It's the with minus the debit you paid is the max gain, right? With the calendar spread, it's a little bit more complicated than that, right? Because mostly because of volatility, right? And volatility changes all the time. It's hard to predict what volatility might do, right? But that the max gain does occur when it expires with the stock exactly at the strike price on the day the short option expires, right? So, but if volatility spikes by, say, 30% or something like that, well, then your max gain could go from like $500 to like $2,000, right? So IV really affects the pricing of these calendar spreads too. So, IV is something you always need to be aware of, I think, no matter what kind of options trading you're doing, but especially with calendar spreads, right? Because it does greatly affect the pricing of your options, right? So, something else to be aware of and keep track of. So I kind of already went over this. It's difficult to ascertain the max gain because it is variable due to IV and how it changes, right? So increased IV will cause it to increase in value, and decreases in IV will cause it to lose value, okay? So, and IV also affects the break-evens on the trade as well, okay? So break-evens widen with increasing IV, right? So if you've got, a 20% increase in IV, then the break-evens, let's say the stock is at 200 and we are in a 200 strike calendar spread, and currently the break-evens are, say, 190 to 210. Well, if IV goes up, say 20, 30%, Well, now all of a sudden the break evens might end up being 170 to 230. Okay. So when do you lose money on these calendar spreads? So you lose money when the stock gets too far from your strike prices, both either above or below, right? So in the 185 calendar spread example, if the stock price drops down to 140, you're definitely going to lose money. But conversely, if it goes up, deep in the money to like 250, you're going to lose money, right? Because you're long on the far dated one, but you're short on the near term one, right? And you'll make money on that long dated one, but you're also going to lose more money on that front dated one, right? And the reason for that is gamma is higher on that near term expiration one, right? So the more that one goes in the money, you're going to lose money at a faster rate than the long term one, right? So what does the risk profile look like on these calendar spreads? So it kind of looks like a tent, right? So in this picture above here, you have what looks to be a 100 strike calendar spread, right? And the break evens on it are 95 to 105, right? So as long as the stock stays between 95 and 105, you're going to make money, okay? So, and you can kind of see in the picture too, it looks like the max gain is about $200 on that if the price stays exactly at 100. But again, if IV increases there, then that max gain might actually end up being $500 instead of $200, right? And then the break evens would increase from 95 to 105 to say 85 to 115. Okay. So having said all that, how do you know which strike prices to pick, right? Okay, so I'm going to use Tesla here for the remainder of these examples. So if your assumption is the stock stays exactly where it's at now, then you would select an at-the-money calendar spread, okay? You can do calls or puts. It doesn't really matter. I generally do calls if I'm doing an at-the-money one, and I honestly, I don't do at-the-money calendar spreads too often, but I will do them occasionally if the stock, say, runs up to resistance, right? And I'm still, I'm neutral to bullish on it, right? So basically, I'm thinking that Tesla, after it hits resistance here, I think it might pull back a little bit, and then kind of bounce back and forth just below that resistance level, and stay below that resistance level for like a week or so, right? So I'm just collecting theta on it, and then a lot of times what I'll do is I'll buy back that short call, and I'll kind of let that long call ride a little bit to see if I can let it go in the money, right? And then I'll add another short call on it for a different date, obviously more near term than the long call. And I'll basically, I'll either do the same strike or I'll turn it into a diagonal spread, right? And that's a little bit different than a calendar spread. I'm not going to go over that in this video, but a diagonal spread is similar to a calendar spread, but it just has different strike prices, okay? So if your assumption is the stock stays exactly where it's at now, then you would select an at-the-money call calendar spread, okay? So if Tesla's at 795, you would do, say, a 800 strike call calendar spread, right? So in that scenario, you're just saying, well, I think Tesla's going to stay around $800 for like the next week or so, right? And you'll make money if it does. If your assumption is the stock goes up and then you select, so then you would select a out of the money call calendar spread, right? So if Tesla is at 795, you would do maybe a 850 strike calendar call calendar spread, okay? If your assumption is the stock goes down, then you would select an out of the money put calendar spread. So if Tesla is at 795, you would do maybe a 750 strike. That should be put calendar spread. All right. Generally speaking, I would look to close your calendar spread between 25 to 35% profit, okay? Or when the stock hits your strike price if it was out of the money, right? So in the 750 strike put calendar spread scenario, you would close it out for sure if it dropped down to 750, right? And most likely you're going to hit 30% before then anyways. So when you enter these, you should have, your good to cancel order in at that 30% mark for sure, right? If you have multiple, if you've got like 10 of them, you can do that for, at least 6 of them, 6 to 8 of them, right? And then let the other 2 ride, because sometimes you can get, like a 200% gain on these calendar spreads, especially if you have IV moving in your favor, right? Okay, so as far as the exact strike price you are using, though, you're just going to use technical analysis to make that decision, right? I'm not going to go into any technical analysis details here in this video. That's for another video. But for example, you grab a 750 put calendar spread because you think Tesla will fall towards 750, right? Because you are bearish due to the price action, okay? And you have a support level down there, or a Fibonacci extension, a moving average, a trend line, something like that. Ichimoku cloud, whatever it is you're using, that's your target, and that's the strike price you're going to pick, okay? Conversely, if you don't have a set target on the chart in mind, right, but you are, bullish, right, then you can just look at the options chain and you can select the near-term option with about a 20 to 30 delta, okay? And then you select the same strike price for the backdated option, okay? So, you're bullish on Tesla and, it's at 795. You pull up the options chain and you look at, next week's short call, the delta, the 25 delta is the 840 strike, okay? You select that one, you sell that call, and then you go the next week or the week after that and you buy that one for the same strike price, okay? Now, how do you know which expirations to pick, right? So the cheapest option usually is to just sell the nearest expiration and then buy the following expiration, right? Sometimes, not always, but definitely if there's, no time, like if you're selling the next week's expiration and then the following weeks, you're buying the following weeks, those are going to be the cheapest ones, right? The more time you have in between the expirations, like if they're 4 weeks apart, those are going to be more expensive than the ones that are, there's no time in between them, right? So there's less debit when the expirations have less time between them. But sometimes the cheapest option isn't always the best option, right? That doesn't mean they don't work, because you will still make money if the stock stays range bound, right? Or moves near your strikes, okay? But sometimes it's better to separate the expiration dates by a few weeks, right? And the reason I do that is because separating the expiration dates by more than 1 week gives you extra flexibility, right? Because you can roll the strikes, right? Kind of similar to that example I was talking about with Tesla, if I'm doing like an at the money one, right? So if you have, you're selling next week's short call and then you're buying one for 4 weeks out and it stays below that strike price, you can collect all that theta, or if it pulls back quite a bit down to the next level of support, you can just buy back that short call and then see if it bounces off that support level. And then if it bounces from that support back up to the resistance, then you can sell another call after it runs up, right? And you can pick a different date, right? So instead of next week's, you would pick 2 weeks out, right? Excuse me. Whew. I thought I was going to sneeze. Okay. So the expiration dates you select affect the options Greeks a lot as well, okay? And the strike prices, of course, right? So the farther out the strike prices are, the higher the deltas are, right? So, if Tesla's at 800, if you pick an 850 calendar spread and you pick the 900 calendar spread, the 900 calendar spread is going to have higher deltas, right? It might be, 12 or 15 instead of a 5, okay? And the more time you have between the expiration dates, the higher the deltas are as well, right? So if you have, the 850 calendar spread with, 1 week apart, and you have the one where the short and long call are 4 weeks apart, the one with 4 weeks apart, that's going to have a higher delta. Okay, so the more time between the expiration dates, then you're also going to have higher theta and higher vega as well. Okay, and that's net overall, right? So with vega, like I said above, it's a little bit more complicated than that, but theta, it's pretty straightforward, right? So when you're looking at the options chain and it says the theta is like 20 right now, so theoretically, if there's no movement in the stock and there's no change in IV, then you'll be up $20 by the next day, right? Because you are net long theta by 20, right? So, the theta on the short one might be, say, 100, and the theta on the long one might be 80, right? So it's, the difference between the two is the net theta, okay? Break evens are also wider with more time between expirations, right? And with farther out expiration as well. So, if I pick like next week's short call and then the following week short call for the 900 strike calendar spread, right? The break evens might be, I don't know, we'll say 875 and 925. But if you pick the short call that's 4 weeks away and the long call that's 8 weeks away, well then your break evens are probably going to be it's going to be at least currently where the strike price is at now, or where the stock is at now. So it'd probably be about 785 to 995 or something like that, right? Like it's going to be a big difference. So when can you use calendar spreads? Okay, so basically you can trade calendar spreads in almost any situation year round, in my opinion. Now, obviously, there's going to be a lot of people that will disagree with that, but I use them all the time, right? I'm a big advocate of calendar spreads. Now, since they say calendar spreads are long vega, right? Many claim you should only trade them in low IV environments, right? Like VIX below 20, or when the IV rank is below 50, right? So, with Tesla, Tesla's, the IV is always high, right? But you want to look at IV rank, and, that kind of tells you the average of what it is over time, right? So if it's below 50, that means that relatively speaking, the IV is low compared to what it normally is. If it's above 50, IV is high compared to what it normally is. So like around earnings, IV rank is going to be, well above 50, right? If you don't understand what IV rank is, again, hit up Google, do a little bit of reading on that one as well, because that's another thing that's important. Again, I have not found this to be true in regards to, it just simply being long vega, right? Just from personal experience and from doing back testing, okay? So as I stated earlier, the front strike is short vega, right? So where IV tends to be higher anyway, right? So IV on that near term option, IV is almost always higher naturally, just by the nature of options, right? And then that back month one, IV tends to be lower, right? And you're long vega on that, right? So even in high IV environments, you still benefit because the short expiration strikes tend to have an increase in IV more than the far dated ones, right? Plus, theta is greater when IV is higher, right? So you're going to collect more theta in a high IV environment, okay? Now, this is where, again, IV is very complicated, right? So this is kind of where calendar splits can really screw you over, right? So if you get a big crush in IV on the longer dated one, but IV stays the same on that near dated one, or even goes up, yeah, then you're going to kind of get screwed over, right? And that kind of situation can happen. It's happened to me before, right? Where I'm actually in a calendar spread, and it's price isn't moving that much. It's kind of right around my strike prices where I need to be, and I check my position, and I'm like, what the hell? I'm down, $200 on it, right? And I look at the options chain. I'm looking at IV, and for some reason, the market makers must have known that I'm in a calendar spread, so they crushed the IV on the long strike, and they increased it on the short strike, right? So I kind of lose money in both directions on the vega side of things, right? So that can happen. It doesn't happen all the time, but just keep in mind that kind of thing can happen. Okay. And also you can also get a situation where IV does go up, right? So you're entering in a calendar spread in a in a low IV environment, right? You're long vega, so you're like, okay, well, if IV goes up, it's going to help me, right? Well, you can also enter into a situation where you're in a calendar spread and the IV on that near-term option goes way up, but the one that's 3-4 weeks out doesn't really move that much, right? So you end up losing money, right? Because when you're short vega and IV goes up, you're losing money, right? And if you're long vega and IV's not going up, then you're not making any money, right? So keep that in mind as well. That's kind of why I say, they're technically not really. You can't just, it's not that simple. You can't just say they're long vega and you should only do them in low IV environments. It's not really true. Just my opinion. So you can use calendar spreads when you think price will stay range bound around a particular strike, especially once it enters a period of consolidation after a big move, like I said above, with Tesla, right? Or you can play directionally, right? So if you think Tesla moves from 800 to 900 in the next month, okay, you can enter a 900 call calendar spread, selling the 900 strike call with 30 days to expiration, and then buy the 900 strike call with 45 to 60 days to expiration, okay, depending on how much debit you want to pay, right? So if you do the long call with 45 days to expiration, that's going to be a little bit cheaper than doing the one with 60 days to expiration, right? Anytime, the longer out you go, the more expensive it's going to be, okay? The one with 60 DTE will be more expensive, like I just said, but will offer more flexibility, and you'll also have higher theta and higher deltas, like I mentioned in one of the bullet points above, right? Okay, so this way, if Tesla chops sideways for a few weeks, you still make money, okay? If it moves in your favor immediately, you make money, right? If it drops, then you would lose less money, right, compared to if you just did a regular call, right? If you're in a regular long call and it drops, you're going to lose more money on the long call that's naked than you are on the call calendar spread, okay? Whereas with the call, you need the stock to move in your favor a lot quicker because of time decay from being short theta, right? If you're short theta, you're losing money with time decay, right? That's just the nature of naked long options. You are at the mercy of theta, right? You are going to experience time decay if the option just chops around, right? You're just going to lose money. With calendar spreads, that's not the case, right? Like I said above, so if Tesla drops, you will lose more money than the calendar, right? If Tesla trades sideways, you'll lose money on a naked long call, right? If Tesla moves up immediately, then this is the one situation where you will make more money on just having a naked long call than the calendar spread. But you know what? Let's not be picky. Let's not be greedy here. We're still making money if it moves in our favor, right? Like instead of making 100% gain, you're making a 30% gain, But this isn't about, and I think this is why a lot of people don't like to trade calendar spreads, because you aren't going to get those 200, 300% moves very often, right? But like I really don't know that many people that make 300% moves on options all the time. And if they say they are, I think they're lying. I think they're full of shit. This trading game is not about that, right? It's just about controlling your risk to reward ratio, right? If you can control your risk, manage your risk, and optimize your risk to reward ratio, you're going to make money over time regardless, right? Doesn't matter if it's, fancy and got all the bells and whistles on it and you're making 300% gains, it doesn't matter, right? People make money with 20% gains consistently, right? And what the name of the game to me is more about consistency and managing your risk and having a good strategy and having a good system. That's all it's about, right? Who cares if it's boring? If it works, it works. You're making money. You're happy at the end of the day, okay? So also with the calendar spread, you can always buy back the short call if Tesla drops, right? Like I mentioned above a couple of times. And then you profit from the short call. And then if Tesla moves back up, you will have profited from both the short call and the long call, right? Assuming you can time this properly, right? So this is not for beginners, right? You have to really be good about managing these calendar spreads, and you have to really be good about reading price action and technical analysis too, right? If you think it's going to, if it drops down to support, you can buy back that short call, and then if you think it's going to bounce, then as soon as it hits that resistance level, whatever you're using, a Fibonacci retracement or something like that, right? Slap a short call on it from there, right? So that will help protect the remaining debit on that current long call that you have that is now naked, right? So you want to flip back to being long theta as quickly as you can, okay? So I think I just kind of said that here in this next bullet point. Then after Tesla moves back up, you can sell another call, either the same expiration you had originally or a farther dated expiration, right? So this is why having more time between expirations gives you more flexibility, okay? Because you can roll short strikes this way, okay? Another way that I use calendar spreads is following options flow, right? And if you're not in our group and you're listening to this video, I really highly recommend you come check out our group. We provide options flow and unusual options activity that we provide to everyone as an additional part of our service. We're seeing like $1 million of flow on Tesla or Apple or some weird ticker, right? So, and if you're in our group, definitely check out the flow room, right? And if the flow is agreeing with the chart, take it, right? If I see 940 strike calls on Tesla coming through for April and the chart is looking bullish to me and I agree with the flow, then I'm likely going to take that trade and turn it into a calendar spread, okay? So I'll go into that here in this next bullet point here. So when I see options flow come in or unusual options activity on, say, the April 14th, 900 strike calls, right? And I like the way the chart looks, I will often enter a calendar spread such as buying the April 14th, 900 strike calls and selling the April 1st, 900 strike calls, right? So this is beneficial for a number of reasons. One, it makes it cheaper than simply just buying the 900 strike calls for, April 14th, right? Two, if you're long, so you're long theta instead of short theta, right? So we're going to benefit from time decay, right? If it doesn't move in our favor or just chop sideways, no problem. We're long theta, doesn't matter, right? Three, gives you more flexibility on the trade, right? So in case it doesn't move right away and chops around or pulls back, right, you're going to lose less money, okay? Five, less, you need to monitor it less, basically. So less need to monitor the trade as closely as if you had a long call, right? And then six, just something to point out, a lot of times I will see this flow work out, but it doesn't work out until like the last second, right? At which point most people have been stopped out or they've capitulated, right? And then you see it like the last 2 days or something like that. You just see this huge ramp, where, Amazon or something like that just goes up like 100 points in one day. And you're like, what the heck was that? And then you look back and you see that flow that you were in, that Kat's posted, and you're like, what the hell? This ended up, going from a 10.00 debit down to like a 2.00 debit, all the way back up to like a 16 debit, right? And if you were in a calendar spread in that situation, you might have been able to hold on a little bit longer, right, and benefited a little bit more because you would have collected premium on that front month, right? So again, I just want to say, check out our Discord group and check out our flow room, right? Because we find some gems just following that flow in there, right? And that's a service that, we pay $100 a month for, and, you're getting that basically as a free add-on of being a part of the group, right? So come check it out. So perhaps my number one strategy is using calendar spreads around earnings, okay? So my pre-earnings IV rush calendars are my most successful trading strategy that I use by far, okay? Over 3 years of logging trades, this strategy has yielded a 78% success rate. Okay, I've been logging these calendar spreads for about 3 years now in my Excel spreadsheet, and they work 78% of the time, right? Pretty good success rate. So basically what you do is I run these pre-ER calendar spreads, and I keep track of all the big major earnings reports, right? And I'll put them on about 2 to 4 weeks before the stock's earnings report, okay? So for example, we'll talk about Tesla, right? So Tesla has earnings on 4/28, right? And it's trading currently at 800, right? And the current date is the 1st of April, right? So we're about 30 days out till the earnings, okay? So what I would do is I would sell the April 14th 900 strike call, and I would buy the April 29th strike call, right? So you're picking the call, the expiration that is just, the one that's of the week of the earnings, right? Because that one's going to get the most increase in IV, okay? And we'll go over that more here in a bit. So, with this, you still generally have to get the direction right, okay, right? You can't just put this on and it's just going to print money, okay? But, you have a lot more flexibility with it, right? So if you were bullish, you would do the 900 strike calendar spread. If you were bearish, you would do the 700, right? But this gives you, like I said, even more flexibility because of the earnings, right? And with the earnings, those long strikes tend to lose value a lot less, right? Because unless they're like super far out of the money, they're going to hold some value because, especially on a stock like Tesla, this thing can move 100 points in the blink of an eye, especially around earnings, right? And, like I said, stocks like Tesla tend to run up in anticipation of the earnings anyway, right? So, right now that's kind of not the case, and I'll go over that here in a second. So, again, if you aren't right initially, then you can let the 900 short call for the 14th of April expire or close it when it's near worthless, and then roll another 900 strike call for the next week, right? So 421 is available, so now you have basically a 900 strike calendar spread, 421, 429, okay? So you're collecting more premium, right? And I've honestly done this a number of times, and a few other members can validate this, but, I'll be in a calendar spread such as this, and, I'll have 3 weeks initially in between, right? Or 4 weeks. And, the first one will expire worthless. And then, I'll collect, say, $100 on that, right? And the long one I'll pay, say, we'll keep it simple. I pay $1,000 for the long call. And then the near term one, I collect $100 on that. And then next week goes by, I sell another one for $200, right? So I sell that one, right? So I'm now I've collected $300, and then on the next one, I sell another one, right? So I end up collecting, $300 on that one, right? So far I've collected $600 on that one, and I paid $1,000 for the original one, right? So, and a lot of times, that one still, again, is holding quite a bit of value because earnings is right around the corner. It's not that far out of the money, right? So I've collected, say, $600 on those other options, but I've only lost like $300 on the other ones, right? On the long one, right? So I've made $300 on it, right? And then, sometimes you can just turn that one into a debit spread, right? So you can sell a short call on top of that. You know, if you're doing a 900 strike calendar spread, you could sell the 920 strike short call on top of that 900 long call, right? So, you know, if you, let's say you've collected $600 in premium, and, you know, you sell the 920 for $600 in premium, well, guess what? You just locked in a guaranteed win of $200, right? Because you paid originally $1,000 for that long call. You've already collected 600 in premium from the other short calls. Now you've added another one for $600. So altogether, even if Tesla drops to zero, right, you have collected $600 from the other ones, and you'll collect another 600 from another one, right? And then you'll only lose $1,000 from that original call, right? Now, if it goes up in your favor to say, you know, above 920, then I should have wrote all this down for you guys, but you'll end up, you know, winning. I think it would be about $1,300 or something like that. So not a bad setup, right? So the reason this strategy works so well is because you are long vega on the call you bought for 429, and the IV rush causes that call that covers ER to increase in value as you approach earnings, because IV increases the closer you get to the earnings report, okay? But the call you're selling and you're short vega on does not experience this IV rush because it does not cover earnings, okay? You wouldn't want to be short vega with IV expected to increase, because you will lose money on that option, right? So again, you'll still need to use some TA in order to find a good entry, but with the nature of earnings and the nature and flexibility of calendars, this gives you a lot more room for error, and need to be, you know, you need to be lot less room for error, and need to be as precise otherwise, right? So once you find your entry, right, your ideal exit, like I said above, is about 30% of your debit paid, okay? So if you paid $1,200, 12.00 debit, then you should be looking to get out at about 15 to 16.00, right? So once you get in, set your good to cancel order. If it hits while you're not looking, perfect, right? If it doesn't hit your target before the short-term expiration hits, then you can roll the short call out 1 week further, okay? You can use a stop loss for these strategies, right? Or a planned exit at about 60% loss, right? So if you entered a 12 debit, you could set a stop loss at 480, right? Conversely, you can close the short call out and wait for that retrace, and then add a short call for a later date, right? So if you have plenty of time in between the two expiration periods, you have that flexibility, okay? Lastly, while not advised by some, you can use this for actual earnings plays as well, okay? Now, the reason you can do this, again, is because you are short vega on the front expiration and long vega on the back expiration, right? So yes, the total spread is net long vega and theoretically should be adversely affected by IV crush. However, the weekly option has way overstated and extremely elevated IV, okay? So much more so than that later dated option, right? So, you know, if IV, you know, sometimes you look at the options chain and IV on the weekly option is like 150%, right? And the long dated one, like 3 weeks out, is still high, but it's like 90%, okay? After earnings, the IV on that weekly one will drop from like 150 to like 50, okay? And then the long dated one will drop from like 90 to 50, you know, or something like that, right? So the other one dropped 100%. The other one only dropped 40%, right? So you can see how that's less of a problem with the calendar spread when the one where you're short vega on drops by 100% and the one you're long vega on drops only 40%, right? So, at best, it kind of cancels out. Okay. So let's say Tesla's at 800 and it has earnings 428 after hours, and today's date is 428. Okay, so you enter the trade within the last 30 to 60 minutes before market close. Okay, generally I look at either the deltas or the expected move when you're setting these up. So you could do 20 or 30 deltas or the strikes at the near term expected move, right? Okay. So let's say the expected move is 100 points. Okay. So you would do a 900 strike calendar selling the weekly 900, which would also be about 20 deltas, and buying the 900 strike call 1 to 2 weeks farther out. Okay. So statistically speaking, you have about a 20% chance the stock doesn't close above that level. But obviously anything can happen on earnings reports. So this is nothing more than a calculated gamble and should only be used with very small position sizes. I can't emphasize that enough. Okay. So this play would make money if Tesla either opens slightly down to flat or to just above the strikes you selected, right? Which statistically speaking has above a 50% chance of making money. Okay. If Tesla tanks to the lower expected move or lower, understand that the calendar can go near worthless almost immediately, right? And you have almost no way of managing the trade, right? Because, it happens overnight after market close and you can't do anything until the next morning, right? Unless you get really lucky and the stock bounces after tanking, which can happen, and it has happened before. So statistically speaking, there's about a 20% chance that the stock drops to that range or lower, right? So, it still can happen. It's not as likely. But again, it still can happen. It's earnings. Anything can happen, okay? If the stock drops, you can always try to buy back the short call, right? And see if there's a dead cat bounce, and then you can sell the long strike. Or just, try to sell another call against it, right? Or you can turn it into a debit spread, right? So just in summary, why I like calendar spreads. Number one, they offer a lot of flexibility. Number two, stocks generally chop around, right? Especially here lately, you don't see, some rocket ride going on, right? So more times than not, you're going to benefit from this, range bound action, right? They're generally a higher probability setup, okay? And also, I love to be long theta and benefit from time decay, as opposed to being short theta and you're losing money from time decay, okay? Number five, multiple applications for use in multiple different scenarios, like I went over above. And it's more passive to me than owning a naked long option, right? To me, you have to monitor the trade a little bit less than a long option. Now, obviously, in some of those examples above, it can get kind of complicated if you're rolling strikes and stuff like that. But if you're using it as like a pre-earnings report setup, which again is one of my favorite setups, you just set an OCO order, and if you get in at 12, set a stop loss at 480, and have a target set for like 1550, right? And if it hits, it hits. If it doesn't, it doesn't, right? So not much to manage there. So let's just go over Tesla real quick. Oh my God, Tesla. So it is bearish looking to me. Multiple times has run up to the 21 SMA and just can't clear it at all. Multiple times, just can't do it, right? And Wednesday was looking kind of bullish after a big gap up, but again, hit that 20 SMA, couldn't do it. Same thing on Thursday, and then Friday we got that big sell-off, and we actually lost support here. We closed just below it, right? So I'm actually expecting Tesla to be in this range here. So actually, for the week ahead, I'm looking for a Tesla put calendar spread, okay? Possibly at the 725 strike, because I think it will run down to 725, okay? And I can set it so that the long strike covers earnings, which I think is at the end of April. Okay. So let's go over that here in a second. So here's Tesla. So like as you can see, it's at 795. That was what it was at market close. So you look at April 1st. So the expected move is 109. But I think I'm going to do the 725 strike. Where the hell is the bid and ask at? Okay. So that's a 26 delta right there. And then let's look for the end of April. So we're just going to grab the same exact one. Again, I have no clue why the bid and ask spread isn't showing right now, but whatever. Okay. And of course, Thinkorswim is going to lag. I could just scream right now. Come on, what are we doing here? Well, that's annoying. Okay, well, I don't know why this isn't uploading. 725. Okay. So normally I'd pull this up if Thinkorswim wanted to cooperate with me. Okay, so just showing me the theta, so that's good. So you can see here, right here on the right side of the screen where this is moving here, theta is 31, so you're going to be making about $31 a day on this calendar spread, and vega is about 50 net. So if IV increases, you should make $50 per 1% net increase in IV. Again, it's not going to change the same on both the April 1st and the April 29th options. So, tough to calculate. But if they both increase by 1% each, you'll make $50, right? And the next day, you'll make $31 off of theta, okay? The delta is negative 14 on this particular. Hey, there we go. It updated the price. Okay, so this is 44.80 debit, okay? Let's go down here to the bottom, and you can see the risk profile on this. So as you can see, the break evens on the upside is actually 810. So the break even is above where it's currently trading at, right? So that gives me a lot of flexibility, even if it just kind of stays right where it's at. Okay, you can see the max profit is about 4,000 on this trade, which is a pretty good penny right now. Again, I'm gonna probably close this out if I enter it at 44. Close it out for about probably about $1,400-$1,500 profit, right? So at most, I'm going to be out of this at probably 60, right? 60 would be my target exit. Now, here's something interesting too. You can see just below max profit, it says the max loss is $2,700, right? But the debit's 44. Now, why is that, right? That's because that long option is still going to have some value in it, right? So really, your max loss most of the time is going to be less than that debit paid. Okay, so keep that in mind as well. Okay, obviously, if you let that April 1st contract expire, you don't add any more short puts to it, and you let the 29th option expire, then yeah, you're going to lose $4,480, okay, which you don't want to do, right? You want to manage these a little bit, right? So, you're either going to exit at a loss of about 50 to 60%, or you're going to roll, say the, let's say you're out of this trade, right? Or Tesla moves up, right? So you're going to roll, after that April 1st one is almost worthless, you'll say maybe add the April 14th one, right? And you'll go to the options chain and you'll slap on that 725. right? Okay. So I hope that makes sense to you guys. I know that was kind of a long, rambling video, but there's really a lot to cover with the calendar spreads. So if you have any questions, head on over to the Discord. I'd be happy to answer any questions you might have on it. But yeah, that's all I have for you guys. Anyone in the Discord group, again, if you have any questions, just ask in the trade chat. Or if you want, I can hop on the voice chat at any time. But yeah, ask any questions you want, and I'd be happy to answer them. I love teaching you guys this stuff, and it makes me happy when you guys learn from it and you start implementing it on your own as well. So, but yeah, that's it. Have a good weekend, guys, and let's kill it this week. All right, bye.